All right, yeah. So thanks for joining the AMA, everyone who's joining us live on Facebook. My name is Said.hamood with Cross Country Mortgage, and I'll let you introduce yourself.
My name is DeCherney with John L. Scott, the Madrona Group.
Yeah, so today we're just doing an AMA, kind of a classic AMA where those who are watching on Facebook Live right now could ask us questions in the chat. Or if you're not able to watch it right now live, of course, you can go back and rewatch it. It's going to be saved on your timeline or on this event page. So you can always go back, watch it, and ask questions to either myself or Henry, and we'll go back in there and answer when we have some time. But yeah, I mean, if anybody is on Facebook and they're in traffic or on I-5 405 right now, definitely turn this on, put it in the background, and take a listen, because we're going to be going back and forth asking each other questions right now regarding the current real estate market, both in terms of mortgage and what's working, what's not working, what we're hearing out there with our clients, and what we're doing to provide solutions for those who still want to buy a house, even though the odds are stacked against a lot of people most of the times. So we're here to bring solutions, here to answer your questions, and let's just get right into it. So, Henry, I don't know if you want to start off first with your question. I know you got a handful of questions for me, and I guess we'll just go back and forth. If that works for you.
Yeah. I mean, I guess one thing a lot of people ask me is what they should expect in the initial conversation with a lender. They kind of don't know how it's going to go, and what they should do to bring or what they should do to prepare. Yeah. So what does it look like when a lender or when a buyer first reaches out to you and just asks about what products you have available?
Yeah, that's a great question. And, in fact, the first step that anybody should be doing when they start the idea of, wanting to go into home ownership and start investing into real estate, is really having that kind of honest conversation with themselves. And if they don't know how to have that conversation with themselves or a significant other, it's good to have that conversation with the mortgage lender so they can have an honest conversation about what they can afford and what's realistic for them in terms of budget and what their overall goals are the next 1 to 5 to 10 years, because as you know, there's a plenty of different mortgage options out there and plenty of different real estate options. So really, I think the first step is just understanding what the goals of investing in real estate is for you. So one of the questions I actually like to ask every new first-time home buyer is, what is your goal? Are you looking to purchase a single family residence, condo, townhouse? Kind of get that out of the way first. Where are they wanting to live? Of course, that way they can work with you and find an actual home in that specific area. And then I like to ask them, what have they done to prepare for their home purchase so far? And I like to ask that as an open-ended question because I want to see kind of where people have done their own research, because it gives me a good baseline of how I could best support them and what they're trying to achieve. So a lot of times people don't do anything up front to prepare. Sometimes people do some research on YouTube or online, and maybe they're starting to save for a down payment. Maybe they're starting to work on credit, pay off debt. But what I ask first is, what can you afford every month? What is a monthly payment goal that you want to stay below? Is it $2,000 a month? Is it $3,000 a month? $4,000? Whatever that might be. What are you realistically going to be able to afford each and every single month based on your current income now? So I asked that question. And then the next question I like to ask is, how much do you have available for savings or available gift funds that you can use towards the purchase of your home? I ask them, what is your credit? Do you have an idea of what your credit score is right now? Because credit obviously is going to dictate how good of a loan you can get, based on, the higher credit you have, the better rate you're going to get. So those are pretty much the main things I like to ask. And I help people prepare for when they're going into that pre-approval process. And the pre-approval process is pretty simple. When you get started, it's filling out an application, an online application, and we are, looking at all of those things: income, credit, liabilities, and really just working based off of their goals.
Excellent. I like that. I like that you ask open-ended questions and kind of figure out what they've done already to prepare and see what, how much research they've done. I feel like it's good that you don't just, immediately start as if they don't know anything, because there's definitely varying levels. I know that the home buying process is complicated, and there are individuals who do a fair amount of research beforehand.
Yeah.
And sometimes that can be a good thing. Sometimes it can be a bad thing, because I know that there's a lot of kind of misconceptions out there too. So it's good that you just let them know what your experience is as a professional, and then, go off of what they already know. So
Yeah. I mean, people come from all walks of life too. And like you said, different education levels in terms of the process of buying a house. So I always like to just kind of feel out who I'm talking with and really understand at the end of the day their goals. Because I think the goals of someone's, decisions or the goals that someone has is going to really dictate the decisions that they make. So I want to help guide them to the best decisions for them.
Yeah, the big why are they doing this? Obviously to get a home, but it can get a lot more specific than that. If they are trying to get a home at some point, but they can't afford it right now, like maybe just getting a condo is what they're looking for, or maybe just information, like how can they just best prepare? So
right. And that kind of leads me into my question too. When someone brand new comes to you, whether they're a family friend or somebody that finds you online, what is the first thing that you recommend they do as a real estate agent on your end of this transaction? What do you recommend that they do first before they start getting into that mode of window shopping, if you will, looking at homes and
endlessly scrolling through Zillow and favoriting things?
Yeah.
So, I mean, one thing that I like to do, and the better agents like to do, is do what's called some people call it a buyer consultation. That sounds a little sterile and kind of, intimidating. So I like to call them new buyer just conversations, because that's mostly what it is. I do have a little presentation that I like giving people, just because there's some information about my company, some background about myself, but really same kind of thing. We just want to go over what their wants and what their needs are. And we do like to go start to finish what the buying process looks like. So, from the start of just searching, talking to us, talking to a lender, and then all the way through till closing, and then what things they could expect all along during that process. But it is really good to have one of those, because setting expectations for yourself about, what it is that we actually do need and what it is that we want, and what things are kind of negotiable in that, where, location, there could be some places that you'd like to live, but a lot of times here in Seattle, it's very expensive to live in certain locations. Okay, maybe we don't necessarily mind living like a little bit further out, or a little bit further north, east, south, or west, or whatever. And then things like, it would be nice to have a garage, but off-street parking is fine. Or it'd be nice to have a yard, but we could compromise with like a big back deck or a large patio of some sort. So it is really good before you start the search to at least have a good, like, 2 columns: wants, needs. And the things that you need are things that are non-negotiable. And those, that's kind of how we'll base the search. Is we'll start by making it a little bit broader than what their needs are, and probably some of the wants too. But then it is also good for them to have a discussion pretty quickly after that with a lender, so they can get that pretty solid information of like, okay, we can afford this, and then we are also approved for this. And in there, I know you do this and good lenders do this, is, here's what the monthly payment would look like. Here, you might be approved for a little bit more, but if you're only comfortable with this range, then we'll only search something that's in that range of the loan. So we don't, and then it also kind of depends on the market as well too. Earlier this year, when things were super competitive, we would set that search price 50 to sometimes 100 grand lower just because of how things were going. 50 grand gives you a fair amount of wiggle room, but that leaves you some space to negotiate if you're, want to put an offer on a house and then all of a sudden there's 5 other people who are putting an offer on a house. You don't have to worry about, are we going to blow out our budget doing this? So,
right.
Yeah.
No, that's very good information too. I mean, 6 months ago, I remember that same conversation I had with multiple real estate agents, and they would get a pre-approval letter and go start shopping with their clients. And the clients always want to, shop at the top of their pre-approval amount, always, it seems like. And, they come back and say, hey, can we get a little bit more? Because it looks like we're going to be in a competitive offer situation. And sometimes, clients do have the income to support that, but a lot of times it's almost like a sticker shock, when you bring a loan estimate back to a client and it's at the price that they want to purchase it at, or they have an escalation clause up to, 50,000 or 100,000 over. They're like, whoa, I didn't realize it's going to be this much of a monthly payment if we went that much higher. So I think, having a good real estate agent like you to understand, like, yeah, you may be qualified up to 800,000, but we know if we do get into something maybe like 700, there could be, in a competitive environment, there could be escalations up to 750, 775. So we want to make sure that you're going to be able to cover that payment at those higher escalations.
Yeah, totally. I think, one of the reasons that caused the last financial crisis in 2007 was people just getting loans that they couldn't afford. And
right.
I want to educate people as much as possible and try to make them as comfortable as possible with this process, and with the fact that, hey, you're buying something that's pretty significant and you want to make sure that you can actually afford it. Like, it might not feel the best, or, it's not all your wants to go a little bit lower, but realistically, you have more of a chance of being able to pay for it, which is, one of the most important things. So, and then having the conversation with them, like, this is not permanent. This is, especially for the first time home buyer, this is the first house that you're going to buy. It's
right.
not your forever dream home. And what this is a tool and a mechanism to build equity that will then be able to get you into maybe your dream home, or maybe something that's a little bit closer to that dream home. So,
right. Yeah. And there's plenty of strategies to, moving up after you've gotten to your first home. And, we can definitely talk about those, later in the conversation, but I kind of want to get a little bit, I want to stay kind of with the simpler questions for those who are, brand new to the home buying process. So in terms of, well, go ahead. I asked you the last question, so you asked me next question.
Yeah. So the one thing that you had mentioned is you'll pull their credit score, or you should know your credit score before going in. What would you say is kind of like a desirable credit score? And then what would you say is something that's kind of like passable, or like a target for somebody to be hitting, that they should try to be getting before they go into shop for a home?
Sure. Great question. So on a traditional conventional loan, which is probably the most sought out after loan, or most common loan for a first time home buyer, is what's called a conventional conforming loan. And basically that means it's a loan that lenders like myself at Cross Country Mortgage would originate, and then we would sell on the secondary market to Fannie Mae, Freddie Mac. So those are the most traditional types of loans that people get, and they require at least a 620 or higher credit score. However, the better your credit score, the better your interest rate is going to be, or at least the cheaper the interest rate is going to be.
Okay.
So anything above a 740, that's going to give you the best pricing in terms of the cost of the overall loan.
And what would, like, say somebody's coming in with a 640 or 620, what would be the difference between that interest rate, I guess, given today's interest rates, and then somebody coming in at a 740? Like, is it a full point, or is it kind of more of a half a point type?
Yeah, it could be upwards of a point, point and a half, depending on down payment and what their credit score actually is. So it definitely does have an effect. Also, depending on the type of property that you're purchasing, that could also affect the cost of the interest rate, whether it's a primary purchase, an investment purchase, or a second home.
Totally. And then I kind of have a follow-up question. What should somebody do if they have bad credit? Is that something that you're able to help with? Are there some suggestions that you have? Yeah.
No, that's a great question too, because especially through this pandemic, a lot of people have gotten into major credit card debt, or just some people have life challenges, and credit gets screwed up. But I think that's a relative question, because we can still help people with quote unquote bad credit. The Federal Housing Administration, or also known as the FHA, they will actually allow people to get into a mortgage, or we can originate mortgages with credit scores as low as 500. But it comes with a caveat where we have to have a 10% down payment for that to be a reality for somebody. If we have at least a 580 credit score, so if someone has a 580 credit score, the FHA will still allow you to get a mortgage and put minimum down. The minimum down for the FHA is 3.5%.
Interesting. Well, I know that there are some down payment assistance programs out there. If you don't mind me just continuing this, piggybacking off that, but so I know there's a pretty common misconception that 20% down is what you should have. You just mentioned 3.5 down. What should somebody expect? And if they don't really have a lot of liquid assets available for down payment, are there, what are the programs that are available for that?
Yeah, so there's a few of them. The first ones are going to be your traditional ones that you've heard before. So FHA, which is a government-backed loan, and they require 3.5% down. That's the minimum down payment that you need for an FHA loan. VA, for veterans, active duty, they have programs 100% financing. So you can get into a home with 0% down, which is awesome. So a lot of veterans who want to move into homes or are moving around, they use their VA benefit to purchase their first home most of the time because of the 100% financing. And then you have USDA, which is mostly, it's only for rural properties. So properties that do actually fall into the eligibility requirements of USDA, they have up to 100% financing as well.
And I do know that, because I have looked at the rural USDA designation map, it's not exactly what you would think of when you think of rural. Like, it is actually, like, there's parts of King County and parts of Snohomish County that are pretty close to cities that are considered rural. So it's not like you're buying some piece of property that's like way out in the wilderness. Like, it can actually be used on something close to civilization. So
yeah, I mean, a lot of people can get surprised with these programs that they can get approved for. USDA, they do have some income, guidelines are a little bit more strict as well. So it comes not as often. I haven't really seen it too much, with my career, but definitely in some of those rural areas, it's a lot more popular.
Totally.
But then outside of those three main programs you've probably heard of, conventional, again, we do have programs as low as 3% down if you qualify. And then the last one is, getting assistance from the state. So we do have programs available through the state, through the Washington State Housing Finance Commission. We can actually help home buyers get their entire down payment covered, plus some closing costs covered using the state's program. So as I had mentioned, the minimum down programs that are available, like FHA, which is 3.5%, or conventional, which is as low as 3%, we can combine that loan program with state assistance, which is down payment assistance. So the state assistance will cover up to 4 or 5% of the loan amount. So 4 or 5% of the loan amount would cover that 3.5 or 3%, down payment requirement, and whatever's left over could go towards some of your closing costs that come along with getting a mortgage.
Yeah, I think that's another thing that people are kind of unaware of too, is closing costs. And I'm sure you as a lender make them aware that there's, beyond down payment and the loan amount, that there are some other things that they will have to pay for out of pocket. And there's some people who I know are not aware of that, those of closing costs. And
Yeah,
so getting that covered just kind of helps another little stressor, like, it's less that they have to bring to the table, or less that
for
they have to
sure.
bring out of
For
pocket.
sure. Yeah, most people would think it's just the down payment that they need to save up to. And once they get it, they're like, all right, now I can go buy a house. But they come to find out, oh my gosh, there's all these things called closing costs on my loan. What is that?
Yeah, and they can definitely add up quick too. So
Yeah, I mean, I think that's a good good leeway into like what are closing costs. So closing costs are going to be about 2 to 3% of the overall purchase price. So a lot of times when you have, the idea of buying a house in mind, you will definitely want to save for the down payment. So figure out what you want to put for a down payment, but then also budget about 2 to 3% of the purchase price for those closing costs. That's typically a good range of, how much they're going to be in total. And closing costs are actually made up of a couple different things. So the first one is going to be any lender fees associated with, whatever lender you're going to be using. And then your third party fees. So third party meaning title and escrow and county fees that come along with a mortgage purchase. So everyone's kind of getting paid throughout the transaction, right? And county, title, escrow, these are all different parties in the transaction that are helping close the transaction so you can buy the house. So there's the third party fees, there's a lender fees, and then there's something called prepaid taxes and insurance. So us as lenders, when we're originating loans for first time home buyers, investors, whoever it is, a lot of times we have to get your taxes and insurance up front when you close on the house and put them into an escrow account, which is kind of like a glorified savings account. So it's your money, but when you look at your mortgage statement or your estimated loan statement, it's going to show, the closing costs with that prepaid tax and insurance included. So it looks like a fee, but it's actually not a fee. It's your money that we're just taking and putting into that escrow account. But it does equal all of it, about 2 to 3%. So you do have to have that money available when you go to that closing table.
totally. And I know that since I work a lot with condos, there's typically a couple months of prepaid HOAs in there too.
Exactly.
Purchasing a condo. So
yeah, and maybe you can share a little bit about this too, because 6 months ago we were seeing homes go 50, 100, 150 over asking. And now we're starting to see kind of the opposite happen, where we're seeing price reductions left and right on homes. And maybe you can share a little bit about what the advantage of buying a home right now is in terms of helping, or at least the seller helping you pay for some of those closing costs. How does that work?
yeah. So what, like you said, what we are seeing is basically the opposite of what was happening 6 months ago, where instead of things going 50 to 100 grand over asking price, sellers are now dropping by like 50 to 100 grand, depending on the price point. I think up until you get up to about $1 million, it's 50 grand seems about like the sweet spot for where sellers are dropping. Over $1 million, you're seeing people drop like 100,000, sometimes more, 150,000. But what I've been hearing from most of my lenders, and you as well, is that instead of having the seller just reduce the sales price by like 25 or 50 grand, to have them do a rate buy down, which I know you can explain it better than I can, because I understand it, but it's your world, so you know the ins and outs of it a little bit more. But more or less, you're getting the seller to offer some closing cost credits, so that's less money that they have to bring to the table, or they're buying down just a portion of your loan, so the interest rate is a little bit lower, so your monthly payments are lower. The seller more or less is getting the same amount. They're just getting they're just helping you pay down a little bit more. So
yeah. So for a seller, you know, if you want to think about it from the seller's perspective, they're selling their house because they want to net a certain amount, right? So as a buyer, you know, you can see what's going on with the market. You can see all these price reductions. If a house has been on the market for 30, 40 days, that's a good indication that they're having a tough time, you know, getting people to come view the house and put offers on the house. So if you come along with an offer, you know, let's say the house is worth, let's say the list price is 500,000. All right. And you have a down payment of 5%. And then let's say you have 15,000 of closing costs that you need to also come in with on top of the 5% down payment. So if I was a buyer and I knew I had to bring in 5% plus the 15,000 of closing costs, and I see this house that I really like that's been on the market for 30, 40 days, I may, you know, ask my real estate agent, hey, can we maybe work out a deal or negotiate with the seller to cover my 15,000, right? So if you were to go and probably, like, you're the agent, so you would do the negotiation. But in my eyes, if I was to write up a contract for 500,000 to the seller of the house and say, hey, I want 15,000 in seller credits to cover my closing costs, the seller may turn around and say, hey, I love your offer, but I want to net a certain amount, you know, if I sell this house. And if I give you 15,000 of my proceeds, you know, I'm going to net less, right? So how about you offer me 515 and I'll give you 15,000 of seller credits. And then to the buyer, it just changes the numbers a little bit. So you're basically financing 15,000 of those closing costs into your loan because you're offering now a higher purchase price to that seller and getting the 15,000 covered.
And then what would the difference in their monthly payment be for that extra $15,000? Would that be something that's significant, or?
Usually, I mean, 15,000 is probably like $40 to $60. I don't have a calculator in front of me, but it's
Right,
not
totally, but yeah. So just that difference is, you know, not a probably, as long as they're within their, you know, budgeted range, it's not going to break the bank, and it could significantly increase, you know, their buying power, or get them help that they might not have been able to get. So
yeah. And, you know, we're seeing a lot of that right now where buyers are more willing to offer seller concessions because they know if they give you 15,000 in seller credits, that's a lot less than dropping the price by 50,000.
Yeah.
You know?
Yeah. So, and it does make, I mean, sellers are definitely very motivated. There's a lot of sellers that are kind of getting nervous these days because things are staying on longer. And, you know, usually if you are selling, there's a reason, unless you're an investor, like you probably are trying to move somewhere, move to the next step in your life. So they need to get that process going. And so they're trying to get that sold.
Right.
Then with the buyers, you know, they are also trying to move into the next step of their life too. So it helps both sides. And I will say though, that before, I think it was 2019, the average days on market was 30 days. And then I think 2010, the average days on market was something like 100. So we're still in like a pretty fast-paced market.
Yeah, absolutely. But, you know, given that we're in this type of environment, we still see a lot of demand for, you know, little inventory. You know, yeah. If a house is priced accordingly, we're still seeing, you know, some competitive offers.
Yeah.
But, you know, it's changing quickly. And I think those who find the right place, who have that perfect seller, you know, ready to get rid of the property, and, you know, you can afford the payment as a buyer, it's most likely a win-win, or most of the time a win-win.
Yeah. So at one of our team huddles earlier this week, we were talking about Gary Keller, the founder of Keller Williams, one of the more successful agents in the nation. He was saying that this market is the most confusing market that he's ever seen in his 40 years in real estate, because it's a seller's market in most metro areas where there's still not a lot of inventory. In the greater Seattle area, we've got less than 2 months of inventory, which means if nothing else came on the market in 2 months, we'd be out. In order for it to be a balanced market, we need to see about 6 months. And then on top of that, because of all the interest kind of volatility, a lot of buyers have backed out because they're just not sure about like what the market's doing. So it's
Yeah.
this weird kind of like, there's not a lot of things on the market, but sellers are super motivated, but there's also not a lot of buyers on the market. So, and then
Right.
you have weird little pockets of Seattle or other places where it still is very competitive. Like West Seattle, I feel like is always going to be competitive because
Especially with that bridge opening up.
this weekend.
Yeah. Yeah. A lot of people who are buying houses over there were, called crazy, but now I'm sure those values are going to skyrocket now that it's opened back up.
Yeah. Yeah. Yeah.
So well, that actually, what you were sharing about, just the type of market that we're in, it prompted me to ask a question about contingencies, because I know 6 months ago, buyers were basically kind of signing their life away with contracts, just trying to get into anything.
Yeah.
Because, as a loan officer, I know those contingencies are there to protect the buyer. Those are included in the contract, and every good real estate agent should be able to explain to you what every contingency means and why it's in there. And maybe you can just share a little bit about, what the contingencies actually are and what we're seeing more of now in terms of having those kind of fail safes in case, something was to go wrong with the loan or something was wrong with the house itself. How are those contingencies able to protect you as a buyer, and what are you seeing right now worked into these contracts?
Yeah, absolutely. Like you said, 6 months ago, we were seeing a lot of offers that were, well, I'll take a step back. Two of the main contingencies that we see are inspection contingency and financing contingency. So inspection is, there's a period right after you write the offer, it's about 7 to 10 days, where the buyer is allowed to get an inspection of the house, read and approve that report. And if there's things that they see that might need repairs, they're allowed to get some bids to just get an estimate of like what a repair cost might be of, say, sewers, some windows, or foundation issues, things that might be an issue or might sway them either way from buying the home. So the earlier this year, there was a lot of people who were offering as is just because it made their offer more competitive. And if you get rid of the inspection clause and contingency, then that period gets taken away and it closes the shortens the closing period. So it basically makes it only about the financing. And then, I mean, if you're a cash buyer, you don't have to wait on the financing contingency.
Right.
And then also the financing contingency is basically like the lenders have to come in and appraise the property, make sure that it is lower than the appraised value, because they don't want to lend on anything that's above the appraised value. And people were waiving that as well too, which really means that if it's over the appraised value, they're basically up to themselves to make up that difference. And I mean, sometimes the lender won't even lend on it, so you're kind of stuck.
Yeah. So yeah, in terms of when we're writing the loan or originating the loan, we order what's called an appraisal to make sure that the collateral, which is the home that you're buying, is going to be sufficient enough to, give you this loan, right? Because we originate loans based on loan to value. If you have 20% down, you have 80% loan to value. 80% of, this loan is, basically the value of the house, right? Well, did I say that right? 80% of the loan is, 80% of the loan, 80% loan to value, it's 20% down. So we want to make sure that the value is coordinated with that, right? So if we get an appraisal and the value comes in lower, which brings your loan to value higher, then you may not be qualified, right? So what you were saying, if the value didn't come in, people would waive that financing contingency, and basically people would have to make up the difference. So if you put in an offer at 500 and the appraised value came in at 480, then people would have to come in with that 20 grand to make up the difference. And that's what people were waiving, you're saying, back 6 months ago.
Yeah. And I mean, I wasn't in the industry before this, but what we were using was appraisal gap coverage, which is the appraisal gap is the difference between the offer price and the appraised value. And so, like you said, it could be like 20 to 50 grand that people were so dedicated and so committed to getting these homes that they were willing to offer it, even if they weren't able to get that loan amount. So then they were having to come up with that amount and the difference. And it was essentially like making your down payment 50 grand larger.
Yeah. And we saw homes in Bellevue. I don't know if you remember that. $1 million over asking.
Yeah. I mean, and like West Seattle, there was some agents that I work with who were, I think 2 of them were both actually bidding on the same one. There was like 20 bids on one home, which was not uncommon in those days. Yeah. But it ended up going, it wasn't $1 million over, but it was upwards of like $700,000 over. And yeah.
That's nuts.
Yeah. Well, and back to your point though, I mean, like I don't ever advise somebody buy something as is, like waiving that contingency. It can make you more competitive. You can do what's called a pre-inspection, which it's the same thing. You're still ordering inspection. You're still getting a full report, and you might be able to get some bids. It kind of depends on the listing agent, but you at least have an idea of what is wrong with the home and what if you're actually comfortable writing an offer on it. If you're waiving that entirely, you have no idea what you're buying. Also, no home is perfect. There's going to be some faults with every home, even new construction. So it's at least good to know what you are going into, and just having no information from the get-go is very not advisable, in my opinion. And, I mean, it's the biggest purchase of your life, and you're kind of just rolling the dice, or at least, and you're paying $100,000 over asking. You don't know that there's a sewer line that needs to be repaired, that as soon as you go underground, prices go up exponentially. So you might have to pay another $100,000 on top of that afterwards in repairs just to make the home habitable. So, and now we're seeing those come back where, full inspection periods, full financing, and it's better. Like it was just uncomfortable for me to write any offers where we waived the inspection. And I very much, whenever I let my buyers know that that's an option to do if you want to be competitive, but I would always steer them to at least getting a pre-inspection, because I want them to have peace of mind when they're buying something. I don't like pushing people into sales, and it's typically about $500 to get an inspection. So I feel like it's very much worth it. If you feel like this is a home that you actually want to make an offer on, just spend the money, and you won't regret it. And then also, now we're also seeing in those seller concessions, in the negotiations, we're able to see people ask for those repairs. Typically though, what I also recommend is that people ask the sellers for that the cost of repairs and closing cost credits. So the seller basically you say, okay, these windows need to be replaced. We got a contractor out here. They say they can do it for $8,000. You can negotiate that into the offer. Be like, hey, we want the seller to give us $8,000 towards this repair. Here's the receipt, or here's the estimate that we got from the contractor that says this is what this amount of work would cost. So
right. No, I think those are all great things for people who are brand new to this, idea of home buying and what the realities are, because, I think most people think, I need 20% down. I'm never going to be able to get enough savings to put 20% down. I get it. There's a lot of misinformation out there. But when you actually come to the realization that there are programs out there to help you, with the down payment if you need it, and the seller is kind of an extension of your support system if you need it, because if at the end of the day, like the way that I look at it, I'm like, if the only way that this deal is going to work is if the seller actually provides seller concessions to the buyer, then that's the only way the deal is going to work. So I always give buyers the benefit of the doubt, even if they don't have any money or if they have limited funds. I say, let's still see what we can accomplish with what we have to work with. Because at the end of the day, paying rent is 100% interest. You know, if you're renting a house, you're already paying a mortgage. You're just not paying your mortgage, right?
Yeah. And sorry if I go off on a little tangent on this. I've been doing a lot of kind of research and posting and yelling on my soapbox, but rents, especially in Seattle, are going up very rapidly. And the rent prices are going up faster than homes are appreciating. And homes are already appreciating in Seattle at now it's like between 15 and 18%, which is still enormous. The national average, I think, is about 5.
Yeah.
But the last statistic that I saw was the average 2-bedroom is $3,800 for $3,800 a month in rent, and that is projected to go up 38%, or it's 38% higher than last year. And then 3-bedroom is almost 10 grand, and that's gone up 245%. And I mean, the amount that you could get for a $10,000 monthly payment is pretty staggering. Like, even with a almost 4 grand monthly payment, you could get a very decent condo in Seattle.
Yeah, I mean, that's a good $500,000-$600,000, purchase price if your payment's at 4 grand, depending on your down payment and your interest rate. Yeah, I think most people don't realize, well, I think they do. I just don't know if there's adequate information, or if they're in a position to, put themselves in that, arena of, hey, I'm ready to get myself pre-approved. And I think there's just a lot of fear sometimes around, people's personal finances. I think one of the big ones that I see a lot is just debt, either car debt, student loan debt, credit card debt. Those things can rack up. And I think when people get themselves in that position, they start to feel, maybe homeownership isn't a reality for me, because number one, I don't have 20% and I don't have closing costs. So, I'm gonna just continue renting. But I think, just like any good professional, you want to go to the doctor when you have an ailment, right? You got to figure out where it's hurting to, have the doctor prescribe you and diagnose what's wrong, right? And if you go to a loan officer and say, hey, I want to buy a house or buy a condo, can you take a look at me and look at my financial, report card or health? Where am I? Most people don't even get to that point, but I would encourage anybody who's kind of thinking about that, at least get yourself talking with a professional so they can tell you what the steps are to get there.
Totally. And I think, yeah, you sent me an email yesterday about student loan debt and how not all of that is counted sometimes. Is that correct? Or was I misreading that because it was 5 a.m. and checking emails first?
I spent it that early, did I? Yeah, no, it's so when we originate loans, depending on the type of student loans that you have, whether they're income-based repayment planned, or you already have like a payment showing up on your credit report, or you have them in forbearance. So there's kind of a few different ways that we can calculate what we need to for your debt to income ratio. So let's say, for example, you want to get pre-approved, you have about 50,000 in student loans, and I look at your credit report, it shows 50,000, but the payment shows it's 0. We either will take a 0.5% or a full percent of that entire balance and count that as a payment against your debt to income ratio. Or if you have an income-based repayment plan, which is usually a little bit lower than that, we can use that against your debt to income ratio. We just need to have documentation showing that that's the case.
Totally.
So yeah, I mean, last 2 people that have helped with student loans, they had over 150,000 in student loans, and we were still able to get them a condo in downtown Seattle.
I just shudder at that number. I've got friends who are in that boat, and it's unfortunate. And I know that there is some relief, but that's only $10,000, and that's kind of a drop in the bucket for like $200,000. And I know that mentally somebody can be like, I have $200,000 in debt. Why would anybody lend me $500,000 more? And I mean, it's not the case. Like, it's always good to talk to a professional like yourself and get a, diagnosis, like you were saying. So
Yeah, and I think if you look at it, people have varying ideas about debt, but if you look at debt, I mean, going 200,000 in student loans, hopefully you went into college with an intention of getting a job that was going to help you pay those off or make a lot more money than 200,000 in debt, right? At the same token, if you're going to get lent 500,000 to buy a house, you're buying it because the value of real estate and assets, right? And you said it yourself, homes are appreciating 5% nationally over year, and in some markets even more, like here. We saw record breaking increases in home values. So just knowing that your house is an asset and that it could appreciate, and over the past 25 years, homes have appreciated to the point where people have become very, very wealthy because of the real estate that they owned. So leveraging real estate in your advantage is something that I think people also need to start thinking about, despite the fact that they have 200,000 in student loans or 100,000 in student loans. Because let's say you did buy a house today and you waited 5 years, and let's say the Seattle real estate market continues to explode and becomes the next San Francisco, where ramblers are going for $1 million. We obviously have a little dip right now because homes are going down, but if you hold on to your asset long enough, traditionally, and from what history has showed us, that asset is going to become a lot more valuable down the line. So you can leverage all of the equity to help pay off certain debts that you have through programs like cash out refinances, to pay off debt.
That both you reminded me of two books, excellent books that I've read this summer, Rich Dad, Poor Dad, where I follow, I believe it's Robert Kawasaki on Instagram. Real big time real estate investor, but he's all about, he's like, I've got loads of debt, but I've got good debt. People just don't understand how to manage their debt. And that kind of connected some things when you're like, you might be taking debt, but you're using it to build an asset. So that's one thing that he preaches. And then also another book, The Psychology of Money. I forget who the author was of that, but they showed a bunch of graphs of not only like it was the stock market and the real estate market, but it's a continual upwards trajectory. Right. The average is a continuous upward trajectory. Yes, there's been the stock market crash, the Great Depression, in the 70s, I believe there was one, and then the 90s .com crash, and then the 2007 housing bubble. All those were little dips, but it has always continually risen. So and that's kind of what I try to tell people, is that regardless of what's going on right now, like the overall picture, unless there's something extremely catastrophic that happens, in which case you've got bigger issues, like real estate is going to continue to rise. Like, it might go down for a couple of years, but then more than likely it will rebound after that.
Right. So, yeah, I mean, look at our parents, man. They came up, and 30 years later, they're in these homes that have made them very, very wealthy. I know my parents, they bought their first home, I think in their 20s. If they would have just held on to it, they'd be sitting pretty well right now. But any investor, which a first-time home buyer would be an investor into real estate, understands that you're purchasing an asset that does appreciate over time based on history. Just like stock market, just like collectibles, gold, silver, these things, if you look back over time, they've traditionally appreciated in value. And I think if you believe in the United States economy and you don't believe it's all going to come crashing down, and you have some hope, this is just another blip and correction in the market, as they say, that everyone's going to be experiencing. Not everything's going to go up forever, because what goes up must come down. But at the end of the day, having a fixed payment for 30 years is way better than rent that is going up way faster.
Yeah. And to your point too, like I forget what the exact number was, but If you're paying, I think it was just $2,000 a month for a couple years in rent, it's something like $200,000. And I don't think people really conceptualize how much money it is that they are actually giving away when they're renting. Like if you're renting an apartment for 5 years, yes, you're just thinking about the monthly payment, $2,000 a month. That's not bad. That's actually great for Seattle. But then when we think about it over 5 years, that's like between $100,000 and $200,000, close to $200,000. And, you know, that's a large number. And you're like, well, shoot, with that money, I could have bought a home. Yes. Yes, you could have.
Yeah.
So, yeah. And then also, like you said, what goes up must come down. The market here in Seattle the last year, 9 months was, it was not fair. And it kind of like, I felt bad for buyers because, you know, going up against 20 different offers, I had a lot of buyers who just
It's like
backed
Disneyland
out.
out the door on open houses.
Yeah. And, you know, like they just got so worn out because the last 9 months they were putting in offer after offer and just being outbid by things they couldn't compete with. And, you know, I want to make sure that people are successful in their home buying journey and are able to achieve their goals. And I mean, we do have parameters that we have to work within. And another blessing of being in the city is that we do have a lot of money, but that comes with a flip side where we do have a lot of money. So there are people who are able to purchase multi-million-dollar homes in cash. And if you're somebody who's a first-time home buyer who doesn't have those kind of assets, you're kind of, you're at a disadvantage, to say the least. So,
Yeah. Yeah, but, you know, but at that point, I think, you know, if there's a will, there's a way. You know, I remember when I bought my first house, I didn't buy it on my own. I bought it with one of my best friends. So we put, it was a total of 10% down, but we each put 5. And you know, we bought pretty much at the bottom of the market where it was $550 for the price of the house. And then I think about 6 months ago, maybe 8 months ago, let's say 6 months ago, the townhouse that's the same as ours sold for $980, something like that. So the appreciation was awesome, you know, and you know, our net worth skyrocketed because of, you know, we put our money together and had an agreement saying, hey, we're not going to raise families in this house. You know, it's not going to be fair for either of us to have families in this house. So we went into it with the understanding that it was going to be an investment property. And, you know, if you have that opportunity to maybe buy a place with a friend or a significant other, you know, combining your incomes, especially right now, is one of the things I see a lot of people doing. And, you know, if that's the only way that you can afford something, that's the only way right now. Don't worry, you know, at least just get yourself into something, but have a plan going into it, you know, because, you know, you could always get into a place, live in it for a couple of years, sell it a couple of years later, maybe come out with 20, 30 in your pocket if you were to buy it with a friend, you know, or in that time you can rent out a couple of rooms and make some money while you're doing it. Like there's always creative ways to make things work. And like I said, going back to my point, you at least just need to get the ball rolling, at least get in a conversation with you or me, just so we can give you some insight of like, hey, this is what you're going to be faced with if you were to move forward. So let's give you some pointers here on how you can prepare yourself and get yourself ready. Because as a professional, as a loan officer, like that's my job, is to be a consultant, to be an advisor, to be your friend, and just help you along the way. Because I think there's just not enough of that education in our traditional school system. So you have to get it elsewhere. And that's where I kind of like to fill the gap. And I like to work with people like you to fill the gap as well.
Totally, 100% agree with you there. There's been a lot of, well, there's been not a lot of financial education. Oh, another fuzzy friend, another helpful advisor.
Little fuzzy friend here.
Yeah, like there is not a great financial education system in America. And I think a lot of people just have a mindset of, you know, everything's, I can't do this, or it's way too complicated, or I can't afford this. And until they have conversations with professionals like us, like we can try to open their mind to, or open their eyes to different pathways. Like you said, I purchased with my friend. Like that might not be something that somebody ever even thinks about, or considers, or like, hey, you could buy this and then rent out some of the rooms as well too. Like just giving them options and just things to think about, even if it's not something they can do now, it opens up options for them and gives them a better mindset to believe that they actually can do something, rather than just, this is not an option for me, I'm never going to be able to do that. So
yeah, I mean, I think that's one of the greatest challenges we as, real estate professionals have, is helping people understand that it is possible. And it is a reality for a lot of people, and there's just different decisions that you have to make, to get to where people are that you see having what you want. They're no different than you. People who have things in life have just made different decisions over a different period of time to get them to where they're at. And we just need to help people understand what those types of decisions are.
And it's also never too late either. Like, you can always start now.
Yeah.
And the best thing that you can do is buy and hold. And if you haven't done it, then just buy now. That was another part of the psychology of money, is like, it's the compound effect, where like the longer that you hold something, the more the interest or the appreciation compounds. And you can get tremendously wealthy off of compound interest. Like, so Warren Buffett got like 90% of his wealth in the last 2 years of his life, or something crazy like that.
Yeah.
And it's kind of mind-boggling numbers to wrap your head around. But, and if you haven't, it's never too late. Like, it's always, you can always start, even if you feel behind. It doesn't matter. Like, as long as you start trying.
Yeah. I think that's a good message to leave, everybody with, because it's been an hour. So you think we covered quite a bit there?
Yeah.
Yeah. Well, yeah, I think that's it's kind of a good place to kind of end the conversation. And if anybody does have, any questions, or they want to meet with us, we're both, pretty local. You're in Seattle, I'm in Kenmore. We can meet anywhere between. My office is in Renton. But yeah, if you do have any questions, or you want to meet up, definitely let us know down in the comments, post or shoot us a DM, and let us know that you want to get together, and we'd be happy to meet up and share your options.
Absolutely. Yeah.
So yeah, any last words for you, Henry?
No. Well, it is a very good market. Other lenders I'm hearing in Fannie Mae says interest rates are probably going to drop back down to around 4%. I've heard Q3. I've also heard Q1 of 2023. Obviously, nobody has a crystal ball, so they can't exactly predict when that's going to happen. But everything that I've been hearing from people that are smarter than me is that right now is a very weird but excellent window for somebody to buy. Yeah. And if you are trying to get into the market and were disparaged by what was going on in the last 9 months, I would try again.
Yeah.
And I also don't know how long this is going to last. And it could go away in a month. It could be a couple months, but it still is a lot different than what we were seeing 6 months ago, 9 months ago. And we're seeing buyers being a lot more, having a lot more success. So.
And you have a soft spot in your heart for people wanting to buy condos, right?
Yeah, I do. I mean, I used to manage condos. I worked for a condo management company. I think it's a great, especially here in Seattle. I think Seattle was one of the first metropolitan areas to really start developing condos. And so for that reason, there's a lot of them here. But I mean, you do have to be pretty careful about what kind of association you're buying into, but I think they can be a great tool for first-time home buyers of, hey, we might not be able to afford a house right now, but we could still live in Capitol Hill, Queen Anne, one of these neighborhoods that's close to downtown, so you don't really have to change your lifestyle that much. And since you're not paying $800,000, which is the median price for a home, you're paying something closer to $400,000, $500,000. It's more or less the same living space that you're at in an apartment, and you're able to keep that lifestyle that you like of, being in the city, which is wonderful.
Yeah. Awesome. Yeah. So if anybody is interested in condos, Henry's your guy. I can definitely help you with the mortgage side of things too, and help with your financing, kind of give you a baseline of what you can afford up to, how much your mortgage payment would be, especially with those HOA that, a lot of these condos have, anywhere from $100 to $800, really just depends on where you are. But yeah, I mean, that's the process, guys. Just getting yourself started, getting the conversation going. And if you need us, we'll be here. So.
Absolutely. Thanks, Ben.
Yeah, of course. Good doing this with you. And again, it's going to be on Facebook for all you guys. And Henry, I'll send this recording over to you so you can distribute it out to your network if you need to.
Perfect. Sounds good.
Take care.
See ya.
Bye.